What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and learn how to think critically about the systems of power shaping our world. My guests in this episode of Hidden Forces are Vance Spencer and Michael Anderson. Mike and Vance are the founders of Framework Ventures, one of the largest venture capital firms in crypto. They've been on the podcast several times before to discuss their investment outlook for this asset class, and you can easily find those previous appearances in the related section to this week's episode page at hiddenforces.io. We spend the first hour of this conversation discussing the current landscape in crypto, the evolution of digital assets since Michael and Vance were last on the show, and the growing institutional adoption of Bitcoin and Ethereum through ETFs and treasury strategies. We also explore recent regulatory developments, in particular the Genius and Clarity Acts, and what they mean for stablecoin adoption and the broader crypto markets. The second hour is devoted to exploring the far-reaching implications of dollar-backed stablecoin adoption outside the United States, how regulatory differences across jurisdictions are shaping innovation in decentralized finance, and the emergence of digital asset treasury companies as major players in the crypto space. We also examine the practical intersections between blockchain technologies and artificial intelligence, including how AI might leverage decentralized finance applications and cryptocurrencies for the purposes of capital formation and data monetization. If you want access to all of this conversation, go to hiddenforces.io/subscribe and join our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. Lastly, because this conversation deals with investing, nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this profoundly important conversation about the future of finance and the growth opportunities facing investors with my guests, Vance Spencer and Michael Anderson. Vance Spencer and Michael Anderson, welcome back to Hidden Forces.
Thanks for having us.
We were debating whether or not this was your third or fourth appearance. I'd forgotten about one of them because you guys had that. Actually, I hadn't forgotten about that like wonderful appearance where you guys came on right after FTX blew up, and Vance shared his experience getting some texts from SBF, which was amazing.
Also on that one, I called Genesis blowing up before it blew up. So that was a little alpha for listeners.
I actually highly recommend people go back and listen to that episode. It was fantastic. So you guys were first on the show back in 2020 during DeFi summer, and then you came back on for the SBF thing, the FTX blow up, and then you came back on a year after that, which I'd forgotten about. I hadn't forgotten about that episode, that conversation, but I kind of rolled it into the conversation with FTX in my memory banks. And in that conversation, if I'm not mistaken, you guys were feeling very bullish about where the industry was headed, in part having to do with kind of institutional capital coming in. The Bitcoin and Ethereum spot ETFs were on the way at that time. So we'll have a chance to cover that. But I guess maybe like the best question to start the interview is just like kind of how have things in crypto evolved since you guys were last on the program?
I think we kind of called a lot of the things that we were going to be discussing today, which is in the last 2 years, we've seen the most success out of any ETF launches in the form of IBIT and ETH, which are the two BlackRock products for spot Bitcoin and ETH. We've seen institutionalization of tokenization with billions of dollars of money markets from BlackRock coming on chain. We've now got regulatory clarity in some aspects, which I know we'll talk about as well, with Genius just going through and getting signed by President Trump. Clarity, which is another one, has been passed through the House, now goes to the Senate. The industry is maturing and getting to a point now where we've been asking for the levels of clarity and understanding that we finally now are starting to get. I think the institutionalization and just the understanding of what this new capital asset is, which is digital assets, is a pretty fundamental shift. It's not, tech trends kind of come and go every couple of years, but we don't create new asset classes very often. And I think that that's really kind of what we're doing now with digital assets.
Vance, you have anything to add there?
No, I think that's a good synopsis of where the market, has gone. And right after, or I guess right before FTX blew up, we had raised $400 million for our third fund. And really that fund was supposed to be, we're a venture fund in crypto. And what that means is you do liquid sometimes, you do venture sometimes, you do distress sometimes, but whatever the game is on the field, that's kind of what we want to play. And what we thought was going to be a venture fund ended up, we called a lot of it right, during/after Luna and FTX and bought a lot of liquid crypto pretty close to the bottom. And at that point, we had LPs bailing on us. We had LPs fighting us, call the capital and buy crypto. And I think, yesterday, actually, I got an apology email from one of those LPs. Don't need to go into who it was, but I think it's pretty indicative of we were out in the wilderness for a long, long time as the industry recovered, but we were buying assets that we had high conviction in. At a certain level, it was an existential bet that crypto would continue on, and that's why we bought a lot of the majors. But then as the industry continued to develop, and especially DeFi started to actually have real earnings power and product market fit, we tended to buy those assets. And so I think right now where we are in the industry's history is it's been institutions love ETH and Bitcoin, but there's this long tail of productive assets that people are kind of ignoring that are starting to spit off serious cash flow. And that's what we're most interested in. And there's some things in our investment thesis that have not worked, mostly consumer and gaming. But I think we're kind of back to our roots, which is DeFi. And that's where we are most comfortable as well.
I actually don't want to forget, because I did at the start of this conversation, I'm an investor in Framework, so bear that in mind. And we're going to talk about securities and crypto-related assets today that may or may not be things that either of us own. So that I just want to throw that out there. So just walk me through this. You mentioned the fact you were buying liquid tokens. Why is this significant? Like, what does it matter whether or not you guys are buying assets that are currently listed and that are being marked to market? And how does that compare to how the industry was working or functioning prior to, let's say, the most recent cycles?
Well, I think in a lot of ways, maybe I'll take a step back and say traditional venture, there's really one format for getting access to deals, which is investing at private rounds and then getting liquidity either through M&A or an IPO. But crypto venture is pretty fundamentally different in that you are able to invest in private rounds where maybe it's equity, maybe it's tokens where the value accrues, but you're also able to make investments that have venture scale outcomes in the liquid markets as well. And in 2017, the overhang of the ICO craze led to a number of assets that were fundamentally productive, really attractive opportunities, but they had liquid tokens. And so in our first fund, which we started in 2019, a lot of the opportunity set was actually in liquid crypto markets for DeFi assets that were already trading and maybe even trading at 99% depressed values to where they launched a couple of years prior. And so in crypto venture, you just have a fundamentally different market structure than what you have in traditional markets. And so that's how we like to look at the field and see what opportunities we have, which is we're both doing private rounds and leading Series A type investments. But we're also looking at the open, public, liquid crypto markets and trying to find venture scale attractive opportunities there too. And so I think when you see depressed values through structural selling, like when Celsius was blowing up and they were for selling all of their assets, those are great opportunities if you have dry powder to be able to go in and backstop those markets at really depressed values. That's what we're talking about when we talk about distressed investing. And in some opportunities, other assets are fundamentally productive, and we'll get into this later, but a lot of the DeFi protocols are actually cash flow positive. They're buying back their own token or distributing value back to token holders, and they're trading in the public markets at price to earnings ratios of single digits. And these are other massively huge opportunities from a venture scale perspective as well. And so you have to be able to, as a crypto venture investor, look at the entire field and be able to operate in all different vectors of it.
Vance, do you have anything to add to that?
No. I mean, there's a lot of colorful anecdotes of, when FTX blew up, there was also someone who hacked FTX. And so they took all the alts in FTX and they just started selling them. And that was a weekend where we bought a lot. And I'm just not sure that there's many investors that can really handle that. It's a really different industry and it's getting more institutionalized, but it will always be the frontier. And I think that's why we love doing crypto. It's right on the edge.
And FTX had purchased a lot of the assets that were distressed during the Celsius liquidation that Michael mentioned before, right? Am I correct in remembering that?
And what was on the balance sheet of FTX or the collective entity of FTX was, remember, Alameda was a very, very large venture investor in the ecosystem as well. And so they had a number of investments that they had been holding on to. And some of them, I can't remember the exact percentage, but I think they bought 5% of Robinhood and 5 or 10% of Anthropic, which now, in retrospect, looked like amazing investments. But at the time, I think the FTX bankruptcy proceedings ended up selling them not as high as they are now. But they were making a ton of investments off of the Alameda balance sheet as well.
I mean, SBF must be rolling, well, he's not in his grave, but rolling in his jail cell because he was telling everybody that this is a liquidity problem. It's not a solvency problem, right? So he's saying, I told you guys, you just gave Alameda a bit more time. I mean, wasn't Alameda, if I'm remembering correctly, it's wild how fast everything moves in this space. I mean, FTX was less than 3 years ago, right? It was November 2022, right?
Correct.
And if I remember correctly, because it's been a while, Alameda Research, not only was it the proprietary trading arm, but it was also the conduit. It was the primary receptacle for all the funds. Everything went through Alameda first, right? Including customer deposits.
Yep. And when everything fell apart, it was just picking up the pieces for almost 2 years after that. There were funds that got trapped in FTX. One that was backed by a major pod shop that they hit us up and they said, hey, we have a week to clear our venture book and wind down the fund. Like, do you want to deal? And, we took 2 days, looked over their entire venture book. We knew exactly what they're holding. We ended up executing on a few deals. And those have been some of our most profitable, investments to date on a multiples basis. And so, whatever you think you're going to do with your crypto fund, usually the market has other plans. And you have to know what you're doing and you have to know why. But you really can never anticipate these types of calamities. And there's all sorts of other stuff that happened. Bad people went to jail. Alex Mashinsky from Celsius went to jail. SBF is obviously in jail. There's also bad people who, at least in our minds, got off. And then there was, frankly, good people who got in trouble for things that we thought were, pretty okay. A good example of that is Roman Storm, and he's still fighting this Tornado Cash legal battle where he tried to build privacy preserving software. And now he is, potentially going to jail for 25 years as a result. And so it's been kind of a mixed bag in terms of holding people accountable. But I think the industry is ready to move forward and put that in the past. And I think initially I was very angry with SBF. Now I'm kind of more of the mind of, does he really deserve 25 years in jail for this? It's kind of like the CEO who got caught with the woman at the concert. Like, how much, flagellation is enough to get them to repent? And, I think at this point, probably better to put things in the past, but also have some sort of idea of forgiveness and clemency for people who have righted the wrongs.
What do you, not to press you too hard on this, Vance, but what do you think would be an appropriate punishment for SBF? Because he did cost many people their life savings.
I don't know, but people say, the death sentence or life is the only acceptable one. I think it's kind of like a Twitter thing where it's just like max punishment all the time. If he got out in 10 or 20 years, I think that would be okay. But the 25 plus, that's really tough to be in a jail cell for that long.
I think that he may have been able to get off on a much lighter sentence had he kept his mouth shut. I think it was what seemed like a true lack of remorse.
Oh, yeah.
That really, dug him in deeply. It's quite remarkable, actually, to watch him bury himself in real time. All the interviews he did, all those conversations he had while he was tweaking on his gaming chair. It was surreal watching that happen. So I had another question floating around in my head. Maybe it'll come back. But here's another one, which is, where is investor capital flowing to today? And what sectors are being left behind in your view?
I would say there are a lot of crypto funds that made career-ending mistakes in the years 2021, 2022, and 2023. And as a whole, over the past couple of years, and we've obviously raised the fund in 2022 and, have had good luck since then. But there's a lot of people who have not been able to raise. And the long tail of crypto funds has, basically died. And so you've kind of culminated into, you have Paradigm and A16Z, which will continue on because of their brand. You have us, you have Multicoin, you have Dragonfly, and then a couple of others, but that's basically the field. There's no Alameda 300-pound gorilla in the room swinging around liquid and also doing venture and then also market making. There's no three arrows that is kind of cut from the same cloth in terms of a multi-strategy, huge risk type of venue. And so you have the venture funds. And what separates the winners from the losers, at least over the past few years, is if you've done liquid and if you picked your right spots. And the people who have stuck solely to venture have kind of been the losers on average. And the ones who have been more liquid have been the winners. But now that the industry is mature enough to have real earnings, cash flow based businesses that are investable at a Series A or higher level, the venture market is starting to come back. But certain themes have certainly died along the way. And this is just our opinion, but the things that have worked best are financial services on chain, stablecoins, lending, swapping, borrowing, derivatives. The historical profit centers of crypto moving from centralized to decentralized is a major theme that's been playing out over the past few years and will only continue to do so. There's also businesses that are B2B SaaS, security businesses that are doing quite well, that are investable. And then I think the things that have died or have not shown success to date, and gaming was a pillar of our fund strategy. We've since kind of come back on that since it really hasn't played out. And then consumer also hasn't really played out. And people have this desire to make crypto, we're going to take Facebook and we're going to put it on chain, or we're going to take Snapchat and we're going to put it on a blockchain. It's just not that. And that's okay. And maybe one day it will be. But today, what crypto is it is the world computer. It is the world stage for finance. It is the only place where finance happens at the speed of software. And every single cycle, the blockchain suck in more and more assets. There's 250 billion of stablecoins. Tokenized T-bills and tokenized fixed income are flooding on chain to the tunes of 11 figures, so $10 to $30 billion today of these assets, and it's only going to continue. And so those things are doing well. Everything else is doing pretty poorly. And so there's winners and losers, but overall, the value proposition that we've talked about for so long is finally playing out. And that's a positive. And all the dumb stuff is just, the NFT exchanges, the meme coins. We've speed run those arcs in crypto, and the value has been extracted, and those have kind of been laid by the wayside. So that's at least my synopsis.
Yeah, only things I'd add are, I think there's been a ton of capital that's been raised for what you would call traditional venture investment dollars and crypto venture investment dollars, where, the LPs look at you in the same bucket as they would a Sequoia or a Greylock or any other venture investor, and you're bucketized in the same format. And so what you're looking at is seed deals, Series A deals, Series B deals, but what that has left is basically a void in the capital markets going after liquid assets, and especially liquid assets that have a productive value. And not only is it Three Arrows and Alameda that are not here anymore, but Tiger Global isn't here anymore. And they were a huge mainstay in the 2021 cycle for liquid investing or even large, late stage growth equity investing, but they're gone. And the liquid funds, at least the ones that we're seeing, they're raising in the tens of millions of dollars, and that's just not a large enough factor to really even be a factor. And so what I would say, to go back to the question, Demetri, is frankly, just there's a void of capital that's in the liquid markets for these productive assets. But I think what we're starting to see is, and we can get deeper into this subject, but digital asset treasury companies, which started with MicroStrategy and has expanded into many, many other types and strategies of these publicly traded entities that are holding crypto. But I think they're going to start to look at this as a mechanism for raising capital for liquid assets that are productive and mature. And I think that that's kind of a recognition of this void of liquid investing and liquid capital going after, public tokens.
No, I would love to talk about that. So, but before we do, just like one more macro kind of zoomed out question here. And that has to do with how you guys have kind of spoken to this already, but I want to get more clarity on what is the sort of bullish narrative today, or what is the overall narrative in crypto? Because we've gone through so many cycles. You mentioned some of these NFT collectibles. We had, back in 2016, 2017, 2018, it was the L1s. There are still some L1s that are competing for capital, but it feels like in some sense they've become kind of almost like meme coins themselves, where there's a pre-existing network effect and a lot of bag holders, and they're just trying to pump the sort of interest in the L1 in order to get people to come in so they can move the price up. I don't know actually how much traction some of these have gotten. There was DeFi Summer, there was meme coins. Also, interestingly enough, this is another question that maybe I'll ask and then we'll continue on this path, which is, do people even talk about base layer security anymore and performance? Is that even a conversation that's happening?
So let's maybe take a 10,000 foot or 30,000 foot perspective. And what we have proven over the last few years is that blockchains are a purpose-built technology for value transfer. And what we have shown is that stablecoins, tokenized assets, even just crypto assets like Bitcoin and Ethereum itself, are those value transfer mechanisms that will underpin all of financial services eventually. What we are still trying to prove out, to the points on consumer and games and maybe NFTs, is, are blockchains purpose-built for data transfer as well? And happy to dive into that eventually, but right now we've proven that value transfer works, and that's what this technology is for. So, when we're talking about what's the future, it's kind of going back to the past. We're going back to the things that in 2019 and DeFi summer, the distribution of financial services and the democratization of access to financial services is really kind of what is working and what will continue to work for blockchain. So are people talking about security at the base layer? Of course, because there's only one place that real world assets or tokenized assets are being put on chain, and that's Ethereum, because it's the most decentralized and it's the most secure. And I think that that's maybe not an abject conversation, but it's definitely part of the thought process when BlackRock wants to put their BUIDL product on chain somewhere. And so I think all this stuff matters, but I think going back to first principles, it's all about financial services and value transfer.
Okay, so that's another one. You mentioned decentralization. Decentralization used to be a huge talking point. Lots of people who use the word didn't even necessarily have a clear idea what they meant by decentralization. I don't really hear this being talked about much anymore. I just think it's almost kind of like an appendix or an appendage that's kind of there in the industry, but no one quite remembers what it was. I mean, so much of what's going on right now that's seems to be underpinning the bullish thesis for crypto is institutional adoption, is regulatory legislation that sort of, helps the industry, quote unquote, grow up. The Genius Act involves AML, KYC regs. So what's sort of the narrative around decentralization in crypto today?
I think the narrative with decentralization is it's becoming more of a regulatory term, in terms of, if you look at the market structure bill that's coming, there's a certain percentage that one insider can own for it to be considered a decentralized commodity. There's also requirements around, the types of nodes people can run and how many there have to be. And I think that's on balance a good thing. Having us as a community nebulously define what decentralization is leads to a bunch of people who are going to try to find loopholes in that and convince people that they're decentralized when they're not. And to be clear, if you build a centralized blockchain, that is a money services business, and you need a regulatory landscape to capture potential wrongdoing there. Same thing with exchanges. If we can build decentralized versions of Binance, we don't need something like an FTX, which is trying to compete and defraud people in that vein while they're pretending to be, a good actor, but actually they're bad. And so that's where decentralization has gone. And just in terms of why Ethereum right now, and Ethereum has, I think, 75% of all stablecoins. It is basically all of the tokenized T-bills and bonds and fixed income that exists today. All of it's on Ethereum. And the reason why is decentralization, but not in a literal sense. So when DeFi summer happened, Ethereum was the only decentralized blockchain other than Bitcoin that had real functionality. And so DeFi summer happens, and then all of these stablecoins come on chain to go farm things, to swap into tokens, to participate in the ecosystem. And then, for all the coins that came on and then, left in terms of stable coins, some of them stayed. And those stable coins became the capital base for more stable coins, more RWAs, more experiments that happens on chain. And so DeFi summer was kind of the moment that, 1,000 flowers bloom from. And it's been path dependent since then. And a good analogy here is, maybe ChatGPT, OpenAI doesn't have the best model. Maybe that's Grok now. But ChatGPT has 1 billion users and Grok doesn't have any. And so it doesn't matter if you can build a blockchain that's more decentralized than Ethereum. It also doesn't really matter if you can build a blockchain that's 100 times more centralized and it's just super fast and super cheap and great. It doesn't have the path dependence where the assets were there and so there became more assets there.
You're describing network effects here.
Right. It's kind of like network effects, but also path dependence of who had it first, who built the network effects, and then how do those persist over time. And so that's where decentralization actually matters. It's in a historical context.
Because of the ownership of the asset? Because of people's ownership of ETH?
Because of people believe that, and I certainly believe this with my money, and I know Michael does as well with his, when you put it on ETH, you have nuclear grade censorship resistance. You're not going to lock up your ETH and borrow against it, and then the blockchain goes down, and then the Oracle price reads 0, and then you get liquidated. Nope. As long as someone runs one Ethereum node, and there's more Ethereum nodes than any other blockchain, that money is safe. And so those types of guarantees are what BlackRock looks for. In terms of, if people are going to be using my assets for leverage, you better be sure that that blockchain never goes down. You better be sure that it cannot be hacked. And you better be sure that there's no bad actor that can change the state of the chain at their own discretion. And so that's like really what decentralization means. We've fought over all these decentralized terms. We've probably like overdone it in a lot of circumstances, but going forward, it's going to be a regulatory term more than anything else, in the sense that if you are centralized, you cannot be traded as a cryptocurrency.
So in some sense, decentralization has become a term of art or sort of an industry term that has a specific legal meaning.
Yes.
Or it will once we have, the Clarity Act.
Well, we're going to get into that too. So one last narrative that I'm just curious about and see how it fits in, because it might flow into a conversation about revenue streams and how some of these various platforms or tokens or coins or projects or whatever term you want to use are monetizing themselves and attracting capital. One of the narratives also that it goes back to the very early days was this distinction between store of value versus medium of exchange. Is this discussed anymore? Because that was largely a byproduct of discussions about competitive advantages between L1s. I don't know that it was really necessarily talked about for layer 2s or anything like this, or tokens or whatever. So is that discussed at all, or how has it mutated into a different type of conversation about value accrual?
So I think maybe store of value has transitioned in the terminology into a monetary premium. And you would have the asset value kind of like some of the parts matrix of like how something is valuable based off of monetary premium plus functional value. And functional value could be based on the cash flows or the value accrual, whatever that may be. Monetary premium is basically just like everything in addition to that builds into the market clearing price that currently exists. Bitcoin is almost completely monetary premium. There's no functional value, there's no fees, there's no value accrual. But ETH, on the opposite side, has some breakdown of monetary premium and functional value based off of the revenue and the token buyback and the burn for the way that Ethereum, the protocol, works. And so I think that's kind of how the conversation goes now, which is you've got some functional value based off of the business model of the protocol that's decentralized and the value flows and the accrual. But then you also have some just based off of governance rights, based off of the fact that it's used as a collateral asset and you can, have multiple functionalities for that token, or just like the brand and the growth potential of what that asset could represent in the future. And so I think that there's the breakdown of the two. And the only one that we've found that's pure monetary premium is Bitcoin. Everything else has some variation of monetary premium plus functional value. And I think this is the new narrative that everybody's coming to, which is you have to have a business for your protocol. You have to have revenue for your protocol. There has to be value accrual for your token. Otherwise, you're going to try and compete against Bitcoin and you're never going to be able to get there. And so, people are starting to get this a little bit. And the assets in the last 6 months, kind of since everything has happened post-election, the assets that have done the best are the ones that have value accrual and revenues flowing back to the token. So happy to get into that too. But I think that's how we break it down, which is in medium of exchange. I mean, stablecoins is medium of exchange. Nobody's using Bitcoin to pay for coffee. As much as we would love to have that be the narrative, that's just never played out. Stablecoins is that. And so medium of exchange is just kind of, owned by stablecoins at this point.
So one more question on that front. Is it fair to make that comparison for the case as a store of value between Ethereum and Bitcoin in particular, because Ethereum switched to proof of stake for both securing the network and also for running leader elections during the consensus process. And it also instituted a protocol. I think, when did the protocol go into effect where it became net deflationary? Was that in 2023 or so? So there are distinctions between these two layer ones. Is there a case to be made still that Ethereum could prove to be the better store of value in the long term?
So I think the first thing is the arc of these technologies is longer than traditional equity companies in the sense that they are never supposed to die. As long as one person runs a node, the technology will continue. And so the quest for which is the better store of value is a very, very long game. And if you think about the things that could happen in the next 10 years, so say quantum happens and you need to come up with a good defense for a fast takeoff quantum scenario where people are using quantum computing to hack your encryption, you need to come up with quantum encryption to feed the quantum computing. That could be a moment that persists for a day, and where Ethereum figures it out and Bitcoin Core is too busy fighting amongst themselves to mount an adequate defense. Over the long term, another example is, people love to talk about the supply cap of Bitcoin. You cannot set a supply cap for your crypto network. The market sets that cap in the sense that, You can say that there's only going to be 21 million Bitcoins, but if there's no security budget, someone in the market will then go and hack your blockchain and change the issuance schedule or steal, all the coins in a 51% attack. For Ethereum, it has a concept called minimum viable issuance, which is 1.5% per year is issued. And then there's a deflationary mechanism via EIP 1559, which what that does is it takes every transaction fee and it burns a portion of it. And that's what makes Ethereum, flat to slightly deflationary. And so which one is the store of value that matters the most? I mean, in the short run, it's been a branding game. It's been a Michael Saylor, buying all the Bitcoin with his treasury strategy game, and kind of a mimetic game with the BlackRock inflows. But now it looks like more of an even fight where Ethereum is accruing more TVL. There's more people using it as a collateral asset. And ETH treasury companies are now the hottest thing in the market. And so what's the better store of value right now? Probably Bitcoin. What's the best store of value in a quantum fast takeoff scenario? Probably Ethereum. What's the best store of value over a 100-year arc where you actually need to figure out what your security budget is for Bitcoin? Probably Ethereum. And I see people go on CNBC, I love Tom Lee, but he was talking about Bitcoin and he said, so one of the anchors asked, what do you say about there's no transaction fees? He says, well, we'll figure that out. So you can't really have that stance if the technology is supposed to live for hundreds of years. You need to figure those things out. And that's what determines what the best store value is.
Okay, one more question, and thank you for indulging me on these more esoteric questions. And then we'll get into the market structure bill, which is the Clarity Act, and some other sort of industry-specific questions. In terms of demand based on geography, the conversations I had with people in Asia, for example, we talked about decentralization earlier, decentralization wasn't really as important. Forget how we're defining it now, but just in general, it wasn't a big thing. I'm just curious, what sort of demand are you seeing there relative to America and to Europe? How are these regions different in terms of what people are looking for, what they're excited about? Just kind of color that picture for me.
In Asia, there is no NASDAQ or New York Stock Exchange. And so people don't dream of building startups that they take public. They dream of launching tokens on Binance. America tends to take the presence of a stock market and equity companies and things like even Y Combinator and a culture of entrepreneurship that's equity-based for granted. But Asia doesn't have that. And so when you go over there, it's a mixture of, we were in Singapore, I think last year, it's crazy, circus. It looks like kind of a combination of Las Vegas and then the New York Stock Exchange. And it's a little bit looser from a rules perspective. But the thing about crypto is that Asia has been power rich historically, but kind of cash or store value poor. And so when Bitcoin came along, all of the big hydroelectric dams in China, diverted some power to go mine it. And so they've had Bitcoin from the beginning. Same thing with Ethereum. It used to be proof of work, so electricity based, and they mined a lot of that. And then with the altcoins, you've had Binance launch their own coin, and that's been massively successful. But there hasn't been as much of a long tail of altcoin innovation in terms of, all the DeFi primitives generally came from the West, and then Asia has since copied them. Mm-hmm. But where Asia has a leg is that, a lot of the consumer and a lot of the gaming angles for crypto are most prevalent there, as well as most of the users. And people are generally less culturally stigmatized against crypto. Michael and I, we are living in San Francisco. Everyone's over the moon about AI. And you tell people you're in crypto and it's you just farted, in the room. People hate you immediately. And you go to Asia and it's just kind of something that's pretty common. And so you always have just probably a warmer audience historically. But now I think what the difference is that all the institutions that buy crypto and are interested in tokenization and RWAs and all of the future things that are really important and meaningful are in the US. And Asia does not seem to have that yet. So It's a moving target, but we love going to Asia and hanging out with all of our founders and teams there. It's definitely a different vibe out here. It's probably more innovation driven. And out there, it's kind of a mixture of the stock market, gambling, and just people having this as part of their lives for a lot longer.
Only thing I'd add to that is I think one of the reasons why it's been that is because of the lack of regulatory clarity here in the West, in the US in particular. In Western Europe, you've had MiCA, which has been around, I think, for a year and change at this point. But we're just now starting to get market structure and clarity on the regulatory landscape in the US, which, to Vance's point, we were kind of the ugly stepchild for a long time from a tech trend, especially post FTX. And Asia kind of took the reins and led the charge in terms of just excitement, energy, trading volume, number of users. whereas that dwindled for a couple of years in the US. I would be very curious to see in the next 2, 3, 4 years, where that kind of shifts. If we do have, market structure and regulatory clarity, I think that a lot of the attention and the economy around crypto is going to come back to the US.
So we might have a chance to talk a little bit more about the differences between the US and Asia, and also specifically about China in our conversation about stablecoins. But let's get into the details here on the recent regulations. So the Genius bill just passed. When did it pass? We're recording this on Wednesday, July 23rd. How long ago was it that it actually passed?
It was signed into law on Friday.
Friday. Fantastic. Okay. So, and we're still waiting on the upcoming market structure bill to pass both houses and to be signed by the president. First of all, before we get into that one, and that's the Clarity Act. So the Genius bill started as the Stable Genius bill, didn't it? Which I think was a better name because it was like, it doesn't stand for something around stable coins. So first of all, what does it stand for? What's in the act? And why did they change the name?
I'm not actually sure what it stands for, but all of these names of acts and bills are kind of just like, we come up with an acronym and then we back into whatever the title will be.
It stands for Guiding and Establishing National Innovation for U.S. Stablecoins Act.
Right. Okay. So it's basically, that's a mouthful. What I would describe the Genius bill as is the market structure bill specifically for stablecoins. Really what we are looking for as an industry and what we've been asking for the last 5 years, market structure. Who is the regulator in each different situation, whether you're launching a protocol, whether you're building an exchange, issuing a stablecoin, accepting stablecoins as payment, all the different interfacing points of this crypto economy need to have understanding as to who's the regulator, what are the rules, and who can operate it, who can't, what do you need to do, how do you need to be licensed, all of that needs to be provided. What we had over the last few years was regulation by enforcement, which means basically the person or people in charge of these different regulators would be able to pick and choose different enforcement actions to take. And we would have to breadcrumb our way through and understanding as an industry what the rules of the road were based off of existing enforcement actions. And if you're an entrepreneur, if you're someone who's building in the space, you don't know if you're going to get a Wells notice next week. And because there's no understanding, there's no clarity. We now have that, at least for stablecoins. And what that basically means is if you are an issuer of stablecoins, so Circle just went public a few months ago, obviously has had a wild reception in the public markets. But I think that kind of underpins the demand and the expectation of future demand for stablecoins going forward. How are you an issuer of stablecoins? What are the things that you need to be as an issuer? What are the rules on how you're backing the stablecoins themselves with assets, which is very short dated US debt or cash? And all of these things are for payment stablecoins. What do you have to do? What do you have to be as an issuer? That's fundamental, but I think that's also pretty vanilla in terms of where the meat of the regulatory bones is really going to come from. And Clarity is basically market structure. What we have with Genius for stablecoins, Clarity is for everything else.
The other stuff I would add is that as as Genius was getting put together, there's certain things that happened. One is that you cannot pass yield back to consumers. The community banks in the US were nervous that stablecoins were going to steal all of their business. And so that was a concession for them to get their lobbyists to agree to this bill for stablecoins. And there's certain things you can do, like having a blocking entity that can allow you to pass back rewards.
What are some of the really big ones that you'd want to point out here that are really important in terms of clarity?
In terms of what?
In terms of having created regulatory clarity and also helping move the industry forward. So you mentioned one of them was paying yield, being able to pay yield on the staking.
You're not able to pay yield on stablecoins.
You're still not able to do that.
No, you can come up with like blocking entities. So for instance, USDC pays interest through Coinbase. Coinbase has a rev share with Circle, who's the issuer of USDC. So there's different workarounds. And technically the cash is coming from Coinbase's balance sheet, but there's a rev share with Circle that makes it possible.
Right, because I was going to say that you can obviously do that through Coinbase.
Right. And so it does introduce centralized intermediaries into certain aspects of stablecoin operations. The other thing that, Michael covered it, but you have to be in short-term debt.
Well, I want to quickly interrupt, but I want you to be able to keep going there. So is that because of the traditional finance industry and like money market funds not wanting to compete with stablecoins?
Specifically community banks, longer tail financial service providers that were worried about competition.
But community banks are already losing deposits to money market funds.
Exactly. And so it's more of we would expect that there will be yield possibilities eventually, but it wasn't something that was included in this initial version.
One more quick question there, and we'll go back to Vance. What percentage of stablecoin deposits are domestic versus foreign?
So this is the fascinating part. There's basically two main providers of stablecoins. There's Tether, which is USDT, and then there's Circle, which is USDC. Tether really was born out of the dollarization of crypto, but started, I believe, in 2016, 2015. I could be off on that. But Tether is primarily in non-US jurisdictions. And the growth of Tether has been a rest of world phenomenon. And they have about 65 to 70% of the market share of stablecoins currently. Circle, which is US based and obviously US centric in terms of its customer base, is about 30% or 25% of the market share of stablecoins. What our expectation is, and this is us kind of prognosticating as to where the future of stablecoins goes, is actually that Tether increases its market share as the industry of stablecoins 5 to 10x's. What our belief is that stablecoins is a great mechanism for using dollars to pay for things, but the vast majority of people in the United States do not need stablecoins for payments. Period, full stop. The people and the market for stablecoins, especially US dollar-based stablecoins, is places that are outside of the US. And so Tether is really in pole position to win the stablecoin market. And Tether is also, I believe, the most profitable business per capita in the history of companies. They made $13.7 billion of profit last year with less than 100 employees. And Tether is just
Of course, we don't know how they've made all that money, right?
No, we do. We do. It's because Tether is backed by US debt and interest rates are 4.5%. And they've got 165 billion in stablecoins.
It's been a long time since I looked into Tether, and I don't necessarily want to get us derailed. There's so much interesting stuff to talk about, and we're going to obviously move this conversation to the second hour. We'll get into all that stuff. But I remember doing a deep dive on Tether some years ago where I watched a bunch of different interviews of a bunch of the different founders. And all I remember distinctly from that deep dive was that I couldn't figure anything out, that it was incredibly opaque. And I didn't understand where the money was. Everyone was being very disingenuous. So Laura Shin had done an interview with the head of Deltec Bank in the Caymans or wherever it was. And there was all this mafia money involved and all that stuff. So has that changed?
Just in the same way that the industry has moved past FTX, the industry has changed in the perspective of what Tether is and what it is backed by and the assets that are underpinning USDT.
So they do attestations quarterly, and they're releasing an audit at some point this year.
That's going to be their first real audit, first independent audit?
Yeah, first independent audit, but they do release an attestation which shows that, they have, I think over 110 billion of treasuries backing 160 billion of USDT.
Well, because attestation is different than audit, and they were refusing to do audits forever. So are they actually going to do an audit, a real independent audit?
They will. I think what is key to understand about Tether going forward, at least, is that, so the Genius Act does not mean that the $165 billion of Tether that exists today is going to be exclusively backed by short-term treasury debt. I think, what Tether's plan is, and this was announced today, is that they're going to launch a separate US dollar for the US stablecoin, which will comport with the Genius Act. But everything that's overseas, and this is kind of key to understand about Genius, is you are going to be seeing the Genius Act versus MiCA, which is the European Stablecoin Clarity Act. And then you have, the Singaporean Stablecoin Act, and then you have other countries, ways of regulating stablecoins. The capital is going to flow to the place that is treated the best. And I think the bear case on the Genius bill is, yes, it's all legal. Yes, it's great. But the business model flexibility of having to be at the short end of the curve, investing dollars there with no ability to go anywhere else, means that those businesses probably won't be the most profitable. And so I think long term, you have to expect that Tether is going to continue to dominate in terms of the profit, per dollar of stablecoins.
So Tether still doesn't offer any yield, correct?
No, they do not offer any yields. And so the separate thing that's playing out within crypto as stablecoins continue to go up is yield coins. And yield coins are this separate category that by default cannot be in the US, which is kind of unfortunate given, that we would like that. But I guess the community banks kind of kibosh that. But these things are growing faster than stablecoins. They're passing back yield to consumers. They're often regulated under MiCA, which has a carve out for decentralized stablecoins and their ability to pass back yield. And so while we may be done with the regulation, it is going to be a horse race between different jurisdictions in terms of the flexibility of the business models that they permit.
All right, so I'm going to move us to the second hour, guys. We're going to talk more about stablecoins because this is one area that's very exciting. And I think the potential for this to accelerate capital inflows into the United States just at the time that a lot of concerns have been raised about capital outflows is pretty remarkable. And then I also want to talk about sort of opportunities in the use of DLTs and blockchain layer technologies for AI industry and kind of what you guys are looking for in crypto heading out of this current cycle. For anyone new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Vance and Michael, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Guys, stick around. We're going to move the rest of our conversation onto the premium feed. If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.